everyone. Thank you for attending the Place Your Trades Spaces Network to discuss the broader oil markets, the U.S. product market, and metals. This Spaces is brought to you by TraderRate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energies, metals, and now Bitcoin. You can use the link in my Twitter stream to go and get the TraderMate app for free. I also write a weekly blog on markets there that you can find at placeyourtrades.com. Our guests this week are TomKloza, who 2 weeks ago couldn't figure out Spaces, so very glad he made it today. He is Global Head of Energy Markets and co-founder of Opus. Opus Oil Price Information Services provides transparency across the global supply chain so that all stakeholders can buy and sell oil and energy commodities with confidence. He has analyzed crude oil, refined products, and gas liquids for over 40 years. He briefly traded petroleum futures back in 1978, but admits he had no business doing so. That was his words, not mine. He also writes commentary for MarketWatch and is a regular guest commentator for Bloomberg Financial and NPR Marketplace. He has spoken at industry gatherings of 100 or more locations across the U.S., Canada, and sits on a number of advisory boards. We also have Gianclaudio Torlizzi. He was born in Rome. After a degree in journalism, he moved to New York City in order to start his career as a financial correspondent from the U.S. for some of the most prestigious mass media companies in Italy, such as ANSA, Corriere della Sera, Secolo.
Perfect.
Did I say it right? All right.
Perfect Italian.
Once he then returned to Rome, he was hired by ADN Kronos in order to start a real-time analysis service on emerging markets and commodities. In 2008, he moved to Milan as a senior editor for Dow Jones, one of the most renowned financial media companies in the world. His main task was to launch and develop a news analysis service on steel and base metals. And then in 2011, he co-founded TCommodity. It's the first consultancy company in Italy specialized in independent analysis on commodities. And then we have Zach, who hopefully will make it up here. Zach Abraham is the principal investment and chief investment officer at Bulwark Capital. Bulwark Capital offers a full range of investment and insurance projects, as well as financial and retirement planning services with over 700 million AUM. Zach has been in the financial services industry for over a decade. He built his career at Russell Investments, working with retirement distribution team. He went on to get a Series 7 and 66 while working for Wells Fargo as a financial advisor. Before starting Bulwark, Mr. Abraham worked as a chief investment officer for Abraham and Company, a boutique broker-dealer and wealth management firm in Gig Harbor. Mr. Abraham holds a bachelor's degree in finance from Pacific Lutheran University. He also hosts Know Your Risk Radio, which airs at 3 p.m. on AM 770, which I actually have had the pleasure to be on. So welcome, everybody. Thank you so much for taking time out of your day. Again, hopefully Zach will get up here. So we'll start with Tom. So we had a huge draws today, Tom, and product draws. So what are your thoughts on the current state of the U.S. product markets as we head into summer high demand season? And can we expect, bigger draws going forward now that maintenance season is basically over?
Well, I first of all, I'd have to say that we're probably in the fifth or sixth inning of the strongest seasonal really in the oil patch, which is the gasoline trade or the RBOB trade. And if you hearken back to December 12th, I believe we had a low tick of 202. And if this were an average rally, an average preseason rally, it would be a 54% increase and take us up to about 311. I think the market's in a little bit of trouble. I mean, it got some good data today from the EIA, but to a certain extent, it's really just clearing out that winter gasoline, kind of like clogging up the bases with slow guys and getting rid of them to make room for the summer gasoline. And I thought it was pretty telling earlier this week when you had the French strikes that have knocked out about 6 refineries. You have Phillips down in Bayway, which is the backyard of the CME delivery. And you also had a fire, a small fire at the Trainer refinery in Philadelphia. And yet gasoline couldn't take off. So I think that an awful lot of the spring rally and an awful lot of appreciation is already built into the prices. Another thing we look at for that is that, if you look at the physical markets east of the Rockies, they're all trading for 15 or 20 cents under RBOB. And even on the West Coast, where typically this time of year you might trade at a 50 cents or a 75 cents premium to RBOB, we're not seeing that. So I think the market's in a prove it stage right now for RBOB. I do think it moves higher, but I think the balance of the run is that it's not going to make it up anywhere near that 54% average preseason rally. And by the way, once you get that peaking window, which typically takes place, let's say, between Cinco de Mayo and May 15th, you tend to get a 15 or a 20% dump in the market. So this year, we have a lot of refinery work that's going on right now, and that pretty much concludes by the first part of May. So be careful out there. I think, it's going to be the kind of market that sings a siren song to a lot of the bulls for RBOB, but I do think there's some problems lurking out there in about 60 days or so. Did I filibuster too long?
Oh, no, sorry. Oh, I forgot to unmute myself. My next question was, how's the Northeast looking as far as diesel is concerned? We know that, Northeast imports diesel from Europe. Looks like Europe's starting to have a little bit of a diesel crunch with the French refineries down, plus the Russian imports ban. So do you foresee any problems affecting the East Coast with that respect?
I think the answer is not really. One of the things we have to realize is that the weakest month for diesel globally is always May. And so, the second quarter, we're not going to see as much demand. And actually, if you look at U.S. diesel year to date, we're down 12.6% or so on demand over a long period of time. And if I were in a closet looking at that data, I would suggest that we're probably in a recession. And maybe we are in one for some of the economic parts of the economy that use diesel a lot, mining, agriculture, freight, and so forth. So, if you listen to refiner fourth quarter earnings calls in January and February, you heard predictions that, Europe didn't have a winter, the United States Northeast didn't have a winter, and there's plenty of diesel for, let's say, February and March, but it'll be a problem in the second quarter. I'm a little skeptical about that view. Refiners certainly appreciate the returns they're getting on diesel now, $40 or whatever. And by the way, if you go back and you did a reversion to the mean, you're talking about the diesel crack over 20 or 30 years is probably about $10 or $12 a barrel tops. So these numbers are really, really epic numbers for refiners. And I do think that they're probably going to have enough. I think the more likely trouble lurks in sort of the November through March 2023, 2024 period. For the people that use heating oil in the Northeast, I would submit that they might be well advised to lock in for next winter's price appreciation for heating oil and for diesel, The problem is they're chasing after receivables, from people who were having trouble paying $5 or $6 for their home heating oil this year. So I think diesel's fine, and I think RBOB will be fine, but it's cruising for a bruising, so to speak. And I think you get those signals if you look at what's happening in the West Coast. But today, without question, today was a real strong statistical day for gasoline, and we'll see how much they can run it up. I mean, we're trading at numbers of $32 or $33 above Brent, and if you go back and you look at recent history and you throw out 2020, we're trading at 10 or $12 a barrel above where the cracks normally are as you start the spring. So I think an awful lot of problems are baked into the prices right now.
Excellent, thanks. We're gonna go. We'll come back to Tom and talk about products more. I want to touch on metals a little bit with Gianclaudio. Obviously, you cover metals markets quite extensively. So, what kind of are your thoughts on base and industrial metals for renewables? I mean, we've seen prices come down quite a bit as far as cobalt, aluminum, nickel, and lithium since the summer highs. Do you think that these prices can last, or are we headed higher, being that the green energy project seems to be on full bore still?
Yeah, exactly. I think that the market is still keeping on the consolidation process that took place in the second half of the last year after the fresh records that has been hit in between March and April 2022, and this consolidation process were in part caused by the strengthening of the US dollar as the Federal Reserve started to tighten the monetary policy, and also because the fact that European economy started to feel the pinch of the energy crisis, which hit pretty hard on our economy. Lately, some doubts emerged about how healthy the Chinese economy could be after the COVID zero strategy implemented by the Chinese government, which quashed demand of the economy last year. My personal thinking is that the market has a very high upside potential in the midterm, even if the macro background is not that positive, as long as we don't know for certain how the current banking crisis will evolve. But beside these, the micro fundamentals of the metals market, the industrial metals market in specific, looks to me very healthy. We over the past 2 weeks, we already saw drawdown in stocks in the Chinese physical market. So the balance is already tightening, and it is important, in my view, to underline the fact that even if that the metals prices can go up even in a context of a not so healthy economy in Europe, because the Green Deal, as you rightly mentioned, is a very important driver. So you don't compared to the previous super cycle rally which started in 2003, probably you remember, until 2011. This super cycle rally, by the way, I think that we are in a super cycle rally, which started with the pandemic. But in this case, you don't have to see a strong contribution from general consumption in order to push metals price higher, because in this case you have the green or the climate policies which represent a bullish driver for all the base metal sector. Just to give you an idea, I read recently a report from Bloomberg NEF which says that almost 10 trillion of metals will be needed by 2050 in order to satisfy the decarbonization targets. So, and if you consider that currently you don't have enough metal to satisfy these needs, which are on paper, but as you can see, policymakers are still are not stopping on that. So they are confirming these plans. So unless we won't see all of the sudden an interruption of the current climate policies, which might happen in case, I don't know, the new U.S. administration will change position on that, or in case after the next European election, the European Parliament and the European Commission will have a different approach on that. So it is still possible that the political shift will damage the fundamental outlook, the midterm and the long-term picture on the base metal. But as long as these, as the current climate policies will be confirmed, in my view, there is no reason to take a structural bearish view on the metals. Of course, in the very short term, US dollar direction will continue to play a role, and of course the tonight meetings of the Federal Open Market Committee will drive the short-term direction of the US dollar. So it might have an impact in the price, also in the metals price. But if you just take this, I think that the fundamental outlook is very, very bullish.
And then, how, if any, how are sanctions against Russia affecting the metals markets? Have we really seen a change in their exports?
Mm-hmm. Yeah, this is one of the unexpected, not for us, because the biggest mistake of our policymaker was not to listening commodity analysts when they decided to apply sanction against one of the biggest commodity producer of the world. But the short-term consequence of the Western sanction against the U.S. was to create to fuel the decoupling process between the West and the East, and to making Russia getting closer to China. So China saved probably the Russian economy by buying a huge amount of oil, natural gas, metals, because if we look at the latest import data, as far as the aluminum is concerned, we will note that there was a jump of almost 100% in February 2023 compared to the previous year, if I'm not wrong. But the increase of the commercial relationship between Russia and China was really big. So the main consequence was to fuel the decoupling process, which started, and in my view, it won't come back in this scenario, European companies are auto-sanctioning against the Russia metals. So many companies decided by themselves not to buy Russia metal anymore, even if, as you know, metals is still not included in the sanction. We have the US government which decided to increase the duty on the Russia metals, but that was a move which did not impact the market that much, because the US already imported not a huge amount of aluminum from Russia. In the case that the base metal complex will be included in the sanction package, as you know, EU implemented the two different sanctions. One, the last 5 December on the seaborne oil, and the other on the 5 February on the petroleum products. So the risk of that my client are a bit worried about is that also metals could be included in another package of sanctions. That would be, of course, an impact, a very strong impact on prices, because we import a lot of I think that the European market, I don't remember now precisely the percentage, but Russia produces something like 15 or 20% of aluminum worldwide. So in case we close the import channel also of metals, that would be an increase of prices, and which probably will be offset by discounted prices that Chinese will manage to buy. So my expectation in that in the end we could end up in two different prices platform. I don't know how to explain, but two different systems: the Western metals or commodity prices and the Eastern one. Because I'm seeing that the world is already split into block, and in my view, it doesn't make sense that just one price will manage to survive. But this is just a speculation by my side.
Yeah, I mean, a lot of people, since we're on this topic, a lot of people obviously are talking about how, you're going to have the bifurcation basically is going to, you're going to have kind of the BRICS bloc minus Brazil trading in yuan, and the rest of the world trading in USD. Now, they've talked about it, but we really haven't seen that come to fruition. Do you expect that at all? I mean, really, does anybody want to hold yuan?
Well, as long as the settlement, the commodity settlement will continue to be done, cleared with the US dollar, there is no reason to expect that the current monetary system will change. For certain, and we have to look at how the Saudi countries will deal with that, because the major source of the engine of the current system is the petrodollar system. So if one day the Saudi Arabia and the neighbor countries will decide actually to proceed to clear U.S. operation with like the Chinese yuan or other currency, that would be, of course, a real game changer. But beside some, announcement related to some transaction that will be done with the yuan or other Asian currencies, I still don't see any kind of, I cannot see yet any kind of change of the current mechanism. But yeah, we have to be very, change things can change very suddenly. So, but for the time being, I don't see any real threat against the current system.
Perfect. Thank you. So we'll come back to metals for sure. But Zach has made it up here, so I kind of want to move this to oil really quickly. And Gianclaudio, if you could mute yourself so we don't get feedback while other people are speaking.
Okay.
So Zach, let's move to oil for a second. So commodity traders, basically, right? The companies that buy, sell, and transport natural resources are particularly vulnerable to rising rates because they rely on huge bank credit lines to finance their trades, for storing, for transportation, et cetera. So obviously rising rates make this much more expensive. So do you think are we finally really starting to see this pressure the oil markets a lot and oil prices in particular? And then what other factors do you see putting pressure on prices right now?
Yeah, I think, as we all know, it's kind of an understatement to say the picture's pretty complicated right now. And one of the things that so first out of the gates, and I hate I hate talking with you about inventories because I feel like I'm talking to Michael Jordan about basketball. But
Right.
yeah, I mean, Tracy's it when it comes to this, and I follow her for that information. But I will say this: we've had several moments where we looked at the inventory information and kind of went, because I'm a long-term energy bull, but you look at the inventory data and you kind of panic for a second, and it's probably happened like 3 or 4 times, and then you go back and factor in the SPR, and you're like, oh, okay, right, that makes some sense. And then the numbers start making sense when you remember to look at it through that lens. So I think it's, as always, we're looking at a wild trade. To me, oil feels very range bound right now, Tracy. I think that the factors that you just discussed are beginning to have some impacts. We're starting to see exports picking up again, which is probably an impact on the China reopening. I just, like with so many other things, and I don't want to sound like I'm not taking a stand somewhere. There's so many cross currents right now, and because I do think, like I said, SPR is certainly clouding the situation. China's lockdown was like them, it was like them launching their own SPR release, and then they did actually release some on top of that as well. And so trying to figure out where that's going to balance out here, I think is kind of a very opaque picture. I do think that you're going to start. I'll just say this: there have been a lot of fundamental macro bear scares over the last 15 years, but I think it's best for everybody to keep in mind that virtually every problem we have faced economically over the last 15 years wasn't really a problem if it could be fixed by money, right? You just print it, fill in the gap. I feel like the markets in general are looking at this issue in the same light, and I think they're really on the wrong foot. The macro picture from our position is really looking dicey, to say the least. As a matter of fact, I'm not sure I've ever seen equity markets more detached from underlying economic fundamentals. And obviously, I'm sure there are other people that'll take the other side. I'll fully respect their take because this is such an opaque picture right now. But I do not think macro is going to be a tailwind at any point. What we do think when we're looking at oil, though, is it feels to me like a very coiled spring. Again, I don't need, I'm not telling any of the speakers on this spaces right now anything they don't know. But the lower oil goes, rig counts already seeing a little weakness there. Rig counts dropping again. Um, I just think you coil the spring tighter. And when you look at the geopolitical picture, right? Oil feels to me like a deep out of the money call you're picking up for nothing. And I think there are there are just so many different factors that could light it up, like Iran getting aggressive and, doing something in the Strait of Hormuz, China rattling the sabers more in time. I mean, there's just so many other factors. And I think the world and the economy are taking stable production for granted. I just see so many factors out there that could really disrupt the transmission of oil around the globe. Governments playing chess and strategically. The other thing is I think that the oil bulls out there bears out there thinking that people are just going to, keep pumping right into a macro slowdown. I don't think that's going to happen. But in the short term, it's a really hard one to pick. 60 looks like a line in the sand. If you get hit below 60 here, we're going to be buyers. But it is a very complicated picture, right? China coming back on, that should help out. Again, seeing the increased exports, but also that macro picture is deteriorating quick. I was looking last night, and I live in the Seattle area. The amount of cranes in the downtown area over the last several years has been unbelievable. That is just stopped on a dime. We have 2 million square foot of A-class office space right now that is vacant in a Seattle suburb. I'm not even talking downtown Seattle proper. So this isn't a commercial real estate discussion, obviously, but what I'm saying is I see very stiff macro headwinds. At the same time, with oil down here, it's not like a lot of new supply is going to be coming online either. So, I think it's a very compelling price here. And but cross currents and conflicting macro winds to us really are the trend right now.
Yeah, absolutely. I mean, I think that fear trade is on once again still. But I wasn't trying to pin you down for an exact price. Don't worry. I know there's a lot of mitigating factors. But kind of moving on to, since we got into kind of some of the macro talk. So let's go into a little bit about, the crackdown on financing and investments within the oil and gas sector, and what impact is that going to have down the road? And what are the dangers of direction of capital for, political reasons? Because obviously we're suddenly we have this green movement from the West, where they would just want to stop everything completely and jump right into, wind and solar and thinking that's going to work.
Yeah, no, great question. And this really leads into the whole aspect of us talking about how this is a coiled spring that's just going to get further depressed. From our view, nobody is. I mean, it's not like the spigot lines for financing have opened up. I mean, I think the general market or overall the market in general is probably more willing to put some money up on on investments on oil companies than it was 2 years ago. But that's counterbalanced by increased regulations and politicians taking stands against oil and divestiture and all these different things. So to us, the math is pretty simple, right? Until we still have a massive shortfall of investment in energy. More, I don't need to report it. I'm sure everybody listening to this has seen it, but the notes out by Morgan Stanley and JP Morgan over the last year and a half or so, talking about the level of investment that hasn't started, right? So we're just still backlogging that. Bottom line is, if we want to meet energy demand by 2030, there has to be substantial investment. And like you pointed out, Tracy, governments are doing everything they can to step on that or disincentivize that. Now, the one thing I will say, obviously, I think politics and the politicians in power are probably, that changeover in power. I expect that over the next several years to be almost as fluid as markets. I think political turmoil is going to be kind of a theme for the age, if you will. And I think one thing that bulls underestimated is how quickly the market can pivot and adjust. One of the things that surprised us, Tracy, is the lack of fall off in Russian production. That's proved to be much more durable than I think, and I'll flat out say it, more than we thought it would be. I was dead wrong on that. And so I think the market has proved to be more flexible and more dynamic, and having the ability to shift and counterpunch a lot more than we thought. But then shifting over on the political scene, look, I think we should all know that by now, the history of governments allocating capital is pretty clear. And I think you see evidence of that in today's economy writ large. I mean, it's all over the place. So the more intervention the government makes into the energy markets, into the oil markets, the more bullish we get long term. We know how this works. If you're talking about a command economy where governments are getting increasingly involved in the direction of capital, you're going to have massive misallocations of capital, right? It's just going to happen. It is part and parcel with that. There are no exceptions. I mean, look, on the margins, maybe there's a couple governments that have made some good decisions over there, but I think everybody knows what I'm talking about. When you look at the lack of investment, when you look at what government is doing, this goes further to us saying that, look, the near term, the interim is a little uncertain. But long term, all of these things spell much higher prices, right? Now, whether is that a range of 100 to 130? I don't know, 140. To me, looking at the world today, I think a good benchmark, and strong convictions loosely held, right? But I think a good benchmark is looking at what the cost of offshore is. If we're looking at what the cost of offshore is, I just have a feeling that oil is going to gravitate toward that, because look at the shale coming out of is it I believe it's Argentina. Forgive me if I'm misspeaking, but look at how much shale makes up of U.S. production. Shale is so much more fragile in terms of production and price. I mean, we should have all learned that lesson over the last 10 years. So I just think whatever price, and we've kind of dog-eared that 120, 130 level, whatever price it takes to make offshore economically feasible writ large, I just think you're going to gravitate to that price over time. And then that's why we kind of look at the oil markets and oil in general as a deep in the money call with massive upside convexity, because I like I said, I think you're going to see that natural gravitational pull toward that offshore price. And then, I mean, the world is a very, very, very interesting place geopolitically, and that could exacerbate moves on an exponentially. So that's kind of the way we're viewing it. I don't know if that answered your question or not.
Yes, that answered my question. Thank you. All right, we're going to go back to products for a little bit. So I just like to go around. So back to Tom. So how are Russian flows affecting the markets with respect that Russia decided to keep that 500K barrels per day for another 3 months? Is that a sign that we're seeing demand waning? I mean, we are seeing some product cargoes pile up offshore.
Well, I think we have to, first of all, you have to consider that most of the Russian refined products that they produced was the middle of the barrel down, whether it be IMO compliant fuel for bunkers or whether it be diesel fuel. And particularly, and this is where I think some of the folks who are very, very bullish on refined products are, they would supply a lot of vacuum gas oil and other intermediates that would be run by more sophisticated refineries than you would find in the former Soviet Union. And I think, that's going to manifest itself. I think it's going to manifest itself mostly in the third quarter of this year and the fourth quarter of this year. I think we get a break in the second quarter. At least we get a break on refined products prices. These numbers are pretty high right now. And these numbers are probably more indicative of what you might see from refined products if you had crude oil prices probably above $80. Now, I want to go back to your previous speaker who was talking about crude. I really do believe that this is the kind of 2023 equivalent of what happened in April 2020, where you have this generational opportunity or you had this generational opportunity, depending how the markets perform in the next few days, to buy crude oil at really, really bottom line numbers. When I look out at the next 3 months, I'll tell you what I see. I see about 410,000 barrels a day of new U.S. refining capacity that's coming online. And by the way, this will be almost the last refining capacity or new capacity comes on in the United States. If you were to lose a refinery on the West Coast this year, it would not be replaced. You'd have to deal with it. So I think we're going to see that additional refined product supply. We're also going to see this very, very extraordinary refinery maintenance season come to a conclusion, probably around the beginning of May. Now, that may mean more gasoline and more diesel for the Atlantic Basin markets and for other markets, but it also means more demand for crude oil. And that, if you overlay that with China coming back and the Chinese reopening, being measured in months as opposed to days or weeks, you're going to have a lot more demand for crude oil as you're getting to the end of the second quarter. So I do think that these numbers, the numbers that we saw earlier this week, the $64 and the $65 WTI numbers, I think they probably represent a reasonable bottom. You might have it go below, some of the costs to bring it to market in the Permian, Midland, for a moment, just like we've seen for natural gas. But I just don't think you're going to look at that over the long term. So in general, I guess I'd say I'm a little bit more bullish on the crude oil benchmarks and a little bit less constructive on refined products. And by the way, I have to take a shot because your previous speaker, and I think he spoke eloquently, Zach, he talked about some of the banks and some of the great things the banks are saying about capital allocation or whatever. Be careful with the banks. Last year around this time, or within the next 30 days or so, we had JP Morgan and a couple of other very large banks suggest that in order to have demand destruction in gasoline, you'd have to see prices of 602, that they ran all the models, and that's what the models suggested. There were a couple of banks that were above $6. What we saw incredible demand destruction, anywhere from $4 all the way up to 502. And you have to kind of come to grips with the fact that in the United States, the right to purchase gasoline at numbers that would be appreciated by the rest of the world is viewed as an inalienable right. And people have a visceral reaction to those prices. So that's why we had the 90-day or 100-day streak of lower prices. And it's something that you need to keep in mind as you look at all, what amounts to very, very good kind of bank research and so forth. So, again, backing up, I agree with the notion that we're probably seeing a generational opportunity for crude oil, but I'm not necessarily on board with the fact that we're going to see gasoline prices go to the sky like we did last year. I think we learned last year about overreactions. I mean, the notion that Russia was going to be down 1 million or 2 million barrels a day in terms of crude oil production and crude oil exports, in addition to having restrictions on the refined products, we now know that didn't happen. And that was one reason why diesel cracks, exploded to nearly $100 a barrel, and gasoline cracks exploded to well beyond $50 a barrel. So watch out for the excess.
Absolutely. Well, if be remiss, I know there's a lot of natural gas traders on this stream, and so we have to talk a little bit about the U.S. natural gas market. Obviously, we've seen an 85% fall from the highs early this summer. Europe has as well, so has Asia. But everybody is wondering if this is going to if prices are going to rebound again. I mean, we're kind of sitting at where we have been, the mean for know, the last, 20 years. But so everybody, the bulls are wondering, is this market going to bounce? You know, is opening, you know, talk a little bit maybe about the U.S. LNG terminals that are opening to export to Europe. Is that looking strong? And the other question people ask is Freeport ever actually going to get up and running? That was for you.
For me?
That was for Tom.
Okay.
Natural gas.
Well, I do believe that we're at a point right now where your bottom line production costs, you know, where the market at Henry Hub is affording you no profit or probably losses. But as we learned in 2020, you can see these prices go below, you know, bottom line production costs for a period of time, and then you get the shut-in. So I do think, you know, certainly we're going to see prices higher 6 months from now, 6 days from now, or 6 weeks from now. I'm not sure. I mean, you know, the United States has such a continental advantage versus every other continent, with the exception perhaps of the Middle East, in terms of natural gas. And it's one of the reasons why our refiners can export so much to Latin America. But, you know, I'm very familiar with the ProShares Boyle ETF, which is, I think, double or triple long natural gas. And for those of you out there that
stay away from those.
yeah, that's making your blood boil these days. So, you know, it's a matter of timing. And I wish I knew. If I did, I wouldn't be sitting here. I'd be, you know, on my yacht in the Mediterranean right now.
Well, do you think that, you know, since we've seen a mild winter, for example, in Europe, and they haven't, I think they just started in having to inject again, but is this going to be a problem for U.S. LNG exports to Europe, or are these guys all on long-term products you pay or forego?
No, I think LNG exports to Europe and to Southeast Asia are going to be very, very brisk beyond, you know, the pale of the next 90 days or so. So it's a question of when, and it's a question of how much suffering can you do with some of the low prices until that happens. But if you look at the, you know, the tremendous contango, and if you look at how Europe really was incredibly lucky with the winter that wasn't this year, you know, it's a matter of timing, and mostly the timing has been very inelegant in 2023.
True. All right, we'll move back to metals quickly. So I'm going to go back to the metals markets and talk about, starting kind of in the fall of 2021, we saw a lot of European smelters forced offline because of high energy prices. How has that shutdown affected the market, and do you think that capacity is ever going to come back? Because it really hasn't so far.
Not at all. The energy crisis was felt heavily by all the industrial sector in Europe, and albeit recently the price, the European benchmark of natural gas prices cooled back, trading just a tad below 50 euro per megawatt hour. Before the pandemic, the average at which the industry was used to was around 15 euro for megawatt hour. So even the current price, which is much lower than the excesses that we witnessed the last summer, is still 3 times higher than the average that we were used to to have. So the industry in Europe is actually, we actually already witnessing a deindustrialization process taking place with some announcement by Volkswagen or BASF, the chemical group, which announced the decision to leave or to reduce investment in Europe in favor of China in the case of BAFT, which is also a political issue now, and also Volkswagen, for instance. Tesla was about to invest heavily in Germany for a Gigafactory. And all of a sudden, a couple of weeks ago, they announced that they will be invest in the US. So the reason was in part of the strong incentives program of the famous Inflation Reduction Act, but which is true, but this is not totally. This is not totally true, because in my view, the general level of energy prices is probably the main culprit behind the recent announcement, and also, as you probably know now, the European Union has unveiled a plan to make itself a bit less dependent from other countries in the electrification process, which is the biggest part of our climate policies. It is put in doubt by the high energy prices, because if energy is a structural high, how can you make competitive a refining process, or a mining or a refining process? Not to talk about how much dependent we might get in case we actually adopt and decided to pursue the decarbonization target put by the European Commission. So we will end up from being dependent on Russia for the fossil fuel to being dependent from China as far as all the metals, rare earth, solar panels, silicon, magnesium. So all these metals and green application, as we know, China has a strong leadership on it. So there is also a geopolitical risk in pursuing such ambitious plan contained in the Green Deal. So yeah, we have to pursue the decarbonization target, which is for sure a very noble effort, and by the way, who wouldn't have decarbonized the world in some kind. But we have to also to consider all the side effects in terms of prices, in terms of structural competitiveness of our industry, which might fall short of the one in China and the US. Just to make you an example, currently the CPI, the Consumer Price Index in China, is 1% compared to 8.6% in Europe. This is a huge gap in terms of competitiveness between the two economies, and we will pay for that. We'll pay in terms of factories which will be forced to close, and we cannot think about protecting ourselves against this just by protectionism, using the protectionism tariff and so on, because in the end the consumer don't have enough money to pay for our product, which are out of the market. So in Europe, the current condition is very challenging, and my biggest fear is beside what happened, because in the moment in which we decided to cut our relationship with Russia in terms of energy links, my biggest fear is how the policymaker cope with that. That's my biggest fear, because you can also have a huge problem, but if you have really smart people, there is a way to overcome this. My biggest fear, and I had a concrete idea of how ideological is now the majority, not all, but majority of policymakers in Brussels, is when last 3 weeks ago I was audited by the European Parliament about the risks of, in terms of dependency from China, of having or pursuing a too ambitious plan in the decarbonization process. And a lot of them was looking at me like I was an alien, because they were not used to. They didn't think that their plan had such side effect to be considered. And the proof you have this proof by the fact that they first unveiled 3 years ago the green plan. And after 3 years, now, they unveiled a plan of how to cover the metals needs by the raw material critical act that which has been announced the last week. In a normal world, you should have done the opposite. First, you should assess what is your production, how really can you increase the refining activities, because the real bottlenecks is not in the mining, is in the refining, which is very polluting, and a lot of people in Europe still don't realize that how polluting is the refining process. But anyway, you should have first have done an assessment about that, and after that, adjust the decarbonization target. We did the opposite, because probably the European policymakers feel themselves as the best in the world, so they are very ideological, and this is the part which scared me the most.
Yeah, absolutely, and I don't think it's just, I don't think that you could discount the United States from sort of going down that same path right now. As a matter of fact, and I think under the new green plan, Europe wants 10% of green metals mined within Europe. I mean, how feasible is that? I mean, you can't even get permitted for
Yeah. No,
10
it's
years.
not feasible at all. No. There's no way. There's no way, because first of all, again, people are not. They don't really understand what these what are the implications, because everybody is green until you start until you don't start refining close to your yard, your garden. So this is the first obstacle, which is huge, because in Italy, for instance, we had a lot of protests just for a regasification plant of the sea, and still ongoing protest in a moment in which we need to increase a lot our import capacity in order to produce some redundancy in our energy capacity, and avoid a new energy crisis in the future. Because this year we were very lucky, because the weather was so hot during the winter. So our energy consumption really decreased a lot compared to last year. That saved us, but it was just by luck. Notwithstanding this, we still have in Italy, for instance, but this is common in Europe, people who are protesting against, just a boat which is poised to gasify the liquid, the LNG, which is coming from the US or from Qatar. So I cannot figure out how what will happen when you actually have to tell you, well, guys, we want electrification everywhere. Well, we need to start to build refining plant of lithium, copper, nickel, aluminum, and which is so polluting as a process, and so this is the first obstacle. The second obstacle is that you need a huge amount of money to upgrade the grid, because if everybody turns on the electricity, then can we imagine how much capacity you will need in order to avoid daily blackout? And so we are now turning off year by year power generated by fossil fuels, replacing them with the green application, which in terms of power capacity are not offsetting that at all. So at least in the US, you are putting a lot of money on that. And at least you have understood that you cannot survive just by using the green. You also need oil, and it was good news for me. I don't know if it's real, but I think it's real that the U.S. administration gave green light to the Alaska drilling. To me, it's a very important step, which underlines the fact that even the current U.S. administration, which put in the green as is label in the beginning, has understood the fact that you cannot make yourself you need fossil fuels in order to pursue a real energy transition. In Europe, unfortunately, we also cannot manage to agree ourselves on the nuclear energy, for instance. We have a tug of war between France and Germany about that. After an energy crisis, which was caused by the fact that the nuclear plants in Germany were not working in 2021. So even after a crisis, we didn't understand. We refused to adapt ourselves to what the market signaled in the past. So that makes me very, 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 very scary. So that brings me to the conclusion that probably we need another energy crisis in order to have a more pragmatic approach on the I hope so, at least, because if we don't adjust ourselves now, we risk really to end up in a very, very dangerous condition. That's my view. Probably it's too pessimistic, but I don't see any real pragmatic approach by the European Commission, the European Parliament.
All good comments. Thank you. I also I have to ask you this. It's a question on tin, because I have a crowd of tin investors on Twitter, and at tin investor asked me to ask you about tin. So what are your thoughts on the tin market? There's a lot of tin used in semiconductors, and that's a growing market. Do you think we ever see the highs of 2022 again? And I don't know, your general thoughts on the tin market.
I don't think so. I think that the tin market is now in a very nice spot to start re-exposing again. Probably will take some time in order to reestablish the bull market, but I think that we remain inside the super cycle for the base metals. So and tin and copper are the metals with the most upside, in my view. So the current dip that we are seeing, in my view, is a compelling spot to re-exposing to this metal again.
Perfect. Thank you. Then we'll go to Zach, and then we'll do a final round after Zach. So, Zach, I kind of want to get into the ESG question with you a little bit. We are seeing finally a little bit of a pushback on ESG, especially some of these big ETFs that just throw everything in a basket and call it ESG. So do you think, and we're kind of seeing some banks pull back on that a little bit. We saw Vanguard drop out of that, the ESG club or whatever that was. So we're starting to see a little pullback. Do you think do you think that we're going kind of ready to move beyond this a little bit? And if so, do you think, do we think we have a boomerang effect where we just go opposite?
Yeah, great question. So right out of the gate, first of all, regarding Gianclaudio's statements, I don't think you can say it any better. I don't think people that aren't in the industry of metals, oil, any type of resource extraction, I don't think that there's a widely held appreciation for how hostile regulators are. I mean, you want to go into the mining sector. I kind of cut my teeth in that sector. I grew up in that sector, spent summers of my life as a child at gold mining sites. And the BLM is looking for scalps in this industry. The hostility of the regulators and their approach, it isn't about facilitating and helping and working with. They're looking for scalps. And so, right, I think the pressure, you might have these pockets. I know nothing about tin, and listen to Gianclaudio talk about that. You might have pockets of stuff that has macro headwinds against it, but in general, that's writ large. And I think that attitude, that hostility, will end only when there is a crisis, as he stated. So I couldn't agree with him more. To me, ESG, as funny as it sounds, it is a product of interest rates. If inflation remains a problem and interest rates remain high, I think I think you've blown a hole in the side of that, happy green rainbow type right investment. The vast, again, I'm not saying anything anybody doesn't know. The vast majority of these green energy companies are not economically viable. Whenever I see the government incentivizing a non-economically viable form of investment, I know there's a lot of fraud, right? I think a lot of these people, the proponents of these ESG funds, are going to begin to wear them at some point. I think investors will get blown up in this stuff. I think, I don't want to get on the political side of it, but if the administration wants to keep pushing the inclusion of that into 401ks, flows might hold that stuff up a little while. But again, in a non-0% interest rate world, I don't think it makes any sense at all.
Yeah, absolutely. And my thoughts on ESG, we've had that conversation before. And plus, a lot of these ETFs are a joke. Right?
Yeah. No, and that's the issue, is that, how do you, this isn't 2020 anymore, and nobody's that's kind of the only attitude that I think can hold that stuff up, is just kind of that YOLO. Oh, we're riding the ride and jumping on the bandwagon. And it's a joke. It's a complete joke, and it's going to get people run over. And like I said, I think the reason you see banks pulling back, and obviously I haven't spoke to the people running Vanguard or anything like that, but it's like you and I have talked about, Tracy. 0% interest rates are like zero gravity, right? Yeah, you can believe as many things as you want before breakfast every day. When interest rates start going up, and let alone where they currently are, the reality starts to set in, and cash flow actually starts to matter. And we've joked around all the time. People are like, "What's with the ESG push?" And I'm sitting there going, "You must not be a money manager. It's a wonderful move by the banks. How else do you charge extra fees to be in an ESG fund, right, and have no accountability as it relates to performance?" right? It blows up and you go, look, we're not benchmarked to the S&P, right? We're benchmarked to people's imaginations. So for Wall Street, as long as it goes, I think it's going to be a wonderful thing, right? Instead of charging 10 basis points on their ESG fund, they can charge 100, right? Because it's ESG. We're making the world better with $1 of investment at a time. And on the flip side, you're not on the hook for performance, right? So for Wall Street, I think it's phenomenal. I think everybody else is going to get fleeced.
Yeah, I agree. And so then let's talk about the question. We had to bring in Powell today, right? So, what do you think Powell does today, and how do you think that will affect the commodity markets? Say, 3 scenarios. He does nothing. He does, first tell us what you actually think he will do, and then, but we won't hold you to it.
Okay.
and then how will it affect the commodity markets? Say if he holds does 25 or does 50?
Yeah. So this is a hot topic, right? Going into today. So I think that we've got to look back. Don't check my numbers directly, but it's somewhere close to this. I believe over the last 25 years, the Fed has made one rate decision that was not previously priced in by the market. Okay, so when I look at that string of decisions, what is that, like a 99.8% congruency rate with the markets there? I think you have to sit there and say the odds are a 25 basis point hike. However, I do think there is something really interesting going on in this debate right now. Everybody is sitting there saying Powell doesn't have the stones to go big. Now, the reason I bring this up is at the last time he spoke, right? He said 50 basis points is on the table. If you haven't noticed, since then, they've said nothing to the contrary, right? Now, the one thing that makes me also think 25 is, the Fed whisperer, our new Fed whisperer, Nick Timiraos, is saying 0 to 25. Again, I think that's the odds on bet. But everybody is saying Powell doesn't have the stones to go bigger or go 50. I honestly think that's a problem that has been created over the last 15 years, right? We are used to Fed policy being conducted in ZIRP with quantitative easing rolling. Okay, when you're in ZIRP with quantitative easing rolling and your inflation rate's about 2%, right? The Fed has been paranoid about going into recession with no bullets to fight back. Okay, that ain't the case anymore. And furthermore, what the Fed really needs done, if you look at what the economy is choking on right now, it's 1, inflation, and 2, higher rates. Do you know what gets inflation and the long end of the curve down at the same time? It's only one thing: recession, right? So the thing that the Fed has been paranoid about for 15 years is now a lifeline of sorts. So do I think he'll pull 50? No. But I think, ironically, it would help if I was in their shoes, which I am obviously not and will never be. I'd roll 50. I might even roll greater than that and launch QE at the same time. I know that sounds crazy, but if, again, we're all looking at it through the lens, right? This Pavlovian response that's been built up over 15 years, right? The Fed doesn't have the stones. The Fed doesn't have the stones. Guys, a 50 bip hike, this may be a little controversial too. I think the quickest way to get the back end of the curve down is via a 50 basis point hike. The other side of it is current levels of interest rates, in my opinion, are plenty high to address the structural inflation we're seeing at this moment. But I think the problem is the behavioral aspect. The markets have been trained over 15 years to hang on and go long. I mean, look, what is the S&P? 4% above where it was before the bank issues came out? That to me is that Pavlovian response. When something bad happens, we're going to print. And I don't see that as helping this time, right? The problem is the opposite. So in my opinion, I think the market is offsides. However, I'm not going to buck 25 years of the market, or excuse me, of the Fed not bucking the market expectation. At the same time, when I'm looking at this backdrop, and the other thing is ECB just hiked 52, right? We know that the central banks are coordinating. So I will just tell you, I'm looking at volatility right now trading at 20, and I'm looking at a Fed decision. I think Powell has more reasons than ever to surprise the market with a bigger hike. Is that what I'm betting on? No. Am I hedged against it? Yes. So that's our take on it. And like I said, I just keep going back. I think the whole issue with this is the market is looking through the wrong lens. I think by pausing and extending, or God forbid, even cutting, if you think about issues, right? We just found a put level on the banking system. Is it 4.75 to 5% Fed funds rate? I think everybody would agree, including the Fed, that inflation has been far more persistent than anybody would. I know there's people out there that said it wouldn't be. I honestly thought rates at this level would have a bigger impact. I'm sitting there looking at this. The Fed put 50 on the table. They haven't taken it off. ECB just went 50. And I'm looking at the Fed saying, hey, whatever steps on inflation and gets the long end of the curve down at the same time is your friend. And I think it buys them time to deal with these issues. On the flip side, if they play it too soft, I mean, I think they're still smarting too. Every time Powell talks, he looks angry, and I get it. But I think it would put them back in the driver's seat. Also, the other thing I think, Tracy, is right. These are people. These are political animals. I think they're all smarting from the constant memes about transitory inflation, the Fed's behind the curve. What would fix both of those issues? Jumping out of the curve today at 50 bips. So I don't think it's the odds-on favorite. I don't think it's a 0% chance. And like I said, I just think it's a pretty convex situation to be able to buy the VIX at 20 heading into this meeting.
Wizard. All right, then. All right, we're way past our original hour, which is fantastic. Gianclaudio had to go, but I wanted to give Tom closing. Usually I do a round of closing thoughts, so if you could just tell us something that, what we should be looking for in these markets in the near term, or in the products markets in the near term, or something that you wanted to discuss that we did not cover so far.
Okay, sure, Tracy. Thanks for having me, first of all. The one thing I would beckon to everybody and to worry about is, 15 years ago, I coined a term that got stolen by George Clooney for the incomprehensible movie Syriana, and that term was petronoia. And every spring, we have about a petronoia where we fear, particularly for gasoline, but last year for diesel, that we're not going to have enough. And the reality is that the inventory systems in the United States are very much like the Bay of Fundy up in Canada. Very, very shallow. So you have tremendous high tides and tremendous low tides. And that really hasn't changed. If you were to compare how much inventory we have vis-a-vis the population, you'd be shocked at how low stocks are now compared to when Jimmy Carter was president, for example. So you do have this tendency to have these tremendous high tides. And we saw some high tides last year where, crude went up to above $130 and refined products went ballistic. And in the case of diesel, remained that way for a while. So be wary of that. As I say, a lot of it is baked into the refined products prices right now. If you were to ask refiners in 2019 or 2021 if they would take these sort of margins for gasoline, for diesel fuel, and for jet fuel, they'd say in a New York minute. There's no question about that. So that's one thing to watch out for. The other thing that I would submit is that be very, very careful as you hear about new refining equipment coming on stream. This is a transitional year. We're going to add about 410,000 barrels a day of new refining in the U.S. Actually, one is a rebuilt refinery that kind of blew up in 2018. But that's going to be increase in the call on crude oil, while probably decreasing some of the margins on RBOB and ULSD. Now, on the other hand, there's going to be a head fake from international refining. you're going to see trailers for refining movies, so to speak. And the trailers are going to talk about these big new units that are opening up. Nigeria has a 650,000 barrel a day refinery that is supposed to get commissioned this year, but commission is almost akin to digging a hole, for shovel ready. It's probably not going to have gasoline or diesel that's going to meet US or European specs until 2024. But that doesn't mean that it's not going to be trumpeted. The same thing is true for some of the big refineries in the Middle East. We're seeing the Al Zour refinery in Kuwait turning out a lot of material for ocean bunkering and for marine usage, but they don't have a diesel that's on spec yet, and they certainly don't have a gasoline that's on spec. But these refineries are coming, and they're coming probably more towards 2023 and 2024. But the people that I deal with in terms of refining don't believe there's enough refining that's going to be added to really meet the demands of the middle of the decade. So this transitional year doesn't mean that we're going to see too much refined products, down the road. And at the end of this year, we're going to close down a huge refinery, the Lyondell Houston refinery. That's about 260,000 barrels a day. So I'm already looking at 2024 and thinking it may be more exciting than 2023, which is, to be honest with you, been sort of boring compared to 2022. So watch out for the overreactions. I think we all realize that in the world of oil, in the world of these commodities, it's kind of a restated Heisenberg principle where every overreaction leads to another overreaction to the upper or the downside. But I do think, as I mentioned before, that the numbers we've seen in recent days for crude oil probably will be looked upon wistfully or nostalgically somewhere down the road. But on refined products, not so much. Oh, and one other thing, I do want to stress this. I know there's a lot of cynicism out there about the administration and about the deal to replenish the SPR. I can tell you they are absolutely resolute in having that buying ready to replenish the SPR. And I know it's a mixed message because they have to sell 26 million barrels in accord with some laws that were passed back in 2015, but they will be purchasing barrels in the marketplace, ostensibly at around $70 a barrel or so. So that is going to be a backstop for U.S. crude.
Do you think that's going to happen this year at all? I feel like it's going to be a while.
I think, well, structurally and because of the way the budget and the way the statutes are, they have to sell that 13 and 6 and 6 in the second quarter first. They have to do that because the money has to be in the treasury. But if the market cooperates, I think they'll be out there buying on a forward basis. So I don't think they're going to replenish, a great deal of it. Certainly nowhere near what was sold off in 2022. But the skepticism or the cynicism there is not warranted. They'll do that. Now, it may be that it'll turn into into an election year and anything goes in 2024. So we'll see. But I do think that the sword of Damocles hanging over the market right now is that 26 million barrels that'll be sold in April, May, and June. But I think beyond that, they'll be buying as opposed to selling.
Well, thank you. And then, Zach, we'll go to you for your final thoughts or talk about something that we didn't cover yet that you wanted to discuss.
Yeah. Regarding, first of all, I couldn't agree more with everything Tom said. I don't want to just say I agree with everybody, but I think when it comes to energy, I'm kind of the dumb guy in the classroom chewing on crayons, compared to you guys. But I couldn't agree more with everybody saying. I think the political risks are the things to watch. I don't see that pressure coming on or that pressure coming off on that side of it anytime soon. And right now, to me, it is all about rates and central bank decisions. I think today is going to loom very large. I think it's a fascinating setup. For years, we've been saying, this print and extend game, kick the can down the road game. That game can be played pretty much indefinitely, right up until the point inflation becomes a problem. And then central banks have a gun to both sides of their head, right? Do we save the market? Do we save the economy? I think this is a fascinating point in financial history. I think it's going to be extraordinarily volatile, much like commodities are. But I will continue to say that over the next 5 to 10 years, I don't think that, at least in the investing landscape, I don't think it's going to look like the previous 10. I think natural resources, and you can kind of see it too, Tracy, right, with the heating up of global political tensions. I just see the board set perfectly for it, especially when you understand and you appreciate the lack of investment that has happened over the last decade. I just think, again, I don't want to overuse the term. I just think commodities are a very coiled spring, and at some point that baby's got to pop. So that's our view.
Excellent. Well, thank you both for coming and spending your time here, and Gianclaudio, who had to leave. Really appreciate all your time and insights. I'm sure everybody did as well. Follow all these people. They're excellent. They're all on Twitter, obviously. Follow Place Your Trade so you can see upcoming events. And with that, we'll see you guys next week. Thank you, everyone.
Thanks, Tracy.
Thanks, everybody. Thank you, Tracy.